So what's your first move off that surprisingly solid jobs numbers report that we just got moments ago? Let's put that question to Truist Co-Chief Investment Officer Keith Lerner. Keith, 467,000 jobs created last month, 4% unemployment rate, and the market has no clue on how to take any of this. How do you take it?
Well, I think by itself, it's 1 month. These employment numbers on a monthly basis, I think you have to look at the trend, not just one number. It's a positive. A little bit skeptical that we had the Omicron spike and that jobs were that strong. But net, I think the bigger picture, though, is that we still think the economy is on solid footing. We think recession risk is low. And this is coming after we created over 6 million jobs last year. That's the most in history. So I think the bottom line is the economy is still on solid footing.
Keith, it's Julie here. So does that imply then that all of this sort of alarm over the Fed pushing the economy into recession, choking off a stock market rally, that's overdone? The economy is strong enough here?
That is our point of view. I mean, there's always a chance that there's a policy mistake, but there's also, whenever you have a transition in Fed policy, it injects volatility because you go from, just applying an abundant amount of liquidity and you move past peak liquidity and the market dynamics change. That's part of the reason why this year, our main mantra was positive yet realistic, knowing that transition in the Fed would create some volatility. What's interesting, we look back at historically, what was the unemployment rate when the Fed started to raise rates? Historically, it was above 6%. So today we're at 4%. So they need to start moving. The last point is historically, going into a Fed rate hike, we see a bit of a market pullback. But over a cycle, we looked at the last 12 cycles, and 11 of those 12 cycles, markets have been up, just at a more moderate pace.
Keith, does the Fed kill the bull market?
Not yet, Brian. I think, listen, if we have 1 hike, 3 hikes, that's not enough to choke this off. It slows the bull market. It injects volatility. Last year, we all had, the shallowest pullback was about 5%. Historically, we have at least 1 double-digit pullback a year. We've seen that already. I think later on, and not right now, at some point, the Fed does typically, kill the bull market because they overdo it. But this will be the first rate hike, and when the real Fed funds, right, the Fed funds adjusted for inflation is still very negative at this point. So we're still relatively loose, but just marginally shifting.
So I guess a corollary to that is, does the Fed kill the bull market in tech stocks? It already kind of has, given especially the drop that we've seen in software stocks going into this year. But, then we had this week, which showed a lot of strength in certain tech stocks. So how should investors be thinking about tech going forward?
Yeah, and tech is such a broad space. So I think the first thing is when you have a transition in Fed and you move past that max liquidity, the companies that are most vulnerable are the story stocks, the concept stocks, the ones that don't have really a lot of fundamentals. And we've seen those down 40, 50, 60%. So the damage there has been done in large part. I think as we move forward, though, the big mega cap stocks where there will be more divergences, I still think they're relatively sound. I mean, good cash flows, valuations have come in as a whole, and we still like big cap tech, where we're overlaying now with our favorite cyclical sectors like energy and financials, which actually, if you look today, they're all outperforming again. So again, I think a barbell strategy makes sense from a sector approach.
But Keith, don't you think the stunning declines we have seen, the likes of Meta this week, PayPal, these stocks have been shredded. Investors have only, for the most part, known stocks like this to go up over the past 2 years. Do you think these harsh reactions have rocked investor confidence?
Yeah, no doubt about it. But this is the difference when you move from a kind of this maximum liquidity. There's going to be a greater differentiate.
Go ahead, Keith.
There's going to be a greater differentiation between the winners and losers, and there's going to be more of a focus on individual fundamentals. That's what you're seeing now. That's what we expect for the rest of this year. And that's a difference, an important one, Brian, what you just noted from the last 2 years ago, where it was all about Fed liquidity. Now it's all about fundamentals and, of course, a solid economic backdrop.